Global precious metals markets are standing at a critical juncture this week as China prepares to return to trading following a 6-session closure for the Lunar New Year holiday. Gold is currently sitting at approximately $5,170 per ounce, while silver is trading near $85 per ounce. As of this broadcast, conditions across markets are described as quiet and stable, but that is expected to change significantly beginning Tuesday, February 24th, Shanghai time, which corresponds to Monday morning between 7 and 8 o'clock Eastern time for audiences in the United States. The Shanghai Gold Exchange, the Shanghai Futures Exchange, and the Shanghai Stock Exchange are all scheduled to reopen simultaneously after 6 consecutive trading days of closure. When Chinese markets last operated on Friday, February 13th, which was a half-day session, gold was trading at approximately $5,400 per ounce, and silver was in the range of $78 to $79 per ounce. China's markets are therefore returning to a gold price roughly $67 lower than where they closed, and a silver market that has moved several dollars higher during their absence. During those 6 trading days, global markets experienced a series of significant developments spanning geopolitical tensions, Federal Reserve policy signals, and notable activity in physical precious metals markets. China's first hours of trading upon reopening are being closely watched by market participants, as the direction established in those opening sessions is expected to set the tone for what analysts are describing as one of the most consequential weeks of the year for precious metals. To understand the significance of China's return, it is essential to examine what occurred in global markets during the period when Chinese exchanges were closed. The holiday closure began on Friday, February 13th, following a half-day trading session in Shanghai. At that point, market sentiment was described as cautiously optimistic. Diplomatic talks between the United States and Iran were ongoing. The Federal Reserve was broadly expected to keep interest rates on hold, and trading volumes were thin ahead of the upcoming holiday. That was the last frame of market data available to Chinese participants before they went offline. The first major development came on Monday, February 16th, which was also the President's Day holiday in the United States. In addition to China, markets in Hong Kong, Singapore, Taiwan, and South Korea were all closed simultaneously, creating what observers described as a triple liquidity drain. Gold held relatively steady during that session, though the absence of Asian buying activity was noted. Conditions changed sharply on Tuesday, February 17th. Gold fell toward the $4,860 to $4,900 range, while silver dropped to approximately $74 at the morning snapshot, with reports of intraday lows falling even further. That represented a decline of more than $150 in gold from the February 13th closing price, and a drop of $4 to $5 in silver. 3 factors were cited in connection with that sell-off. First, the liquidity vacuum created by the continued absence of Asian markets. Second, reported progress in peace negotiations involving both Iran and Ukraine, which reduced safe haven demand. Third, a modest strengthening of the United States dollar. Also, on February 16th, BHP signed a $4.3 billion silver streaming agreement with Wheaton Precious Metals, described as the largest streaming transaction in history based on upfront consideration. Under the terms of that deal, BHP will deliver silver from its 33.75% share of the Antamina mine in Peru to Wheaton, initially delivering the full share until 100 million ounces have been delivered, and then dropping to 22.5% for the remaining mine life through the year 2036. Wednesday, February 18th brought a reversal in market direction. Minutes from the Federal Open Market Committee's January 27th and 28th meeting were released at 2 o'clock in the afternoon, revealing that committee members were divided on the future path of monetary policy. Some participants argued that interest rates may need to be lowered. Others favored holding rates at current levels. A third group suggested that rates might need to be raised. Several members also indicated support for adopting language that would place rate increases back on the table in the event that inflation fails to continue declining. Gold rallied on that day, with Fortune reporting a price of $4,992 at 10 o'clock in the morning on Thursday, up from approximately $4,957 the prior morning. Additional signals emerged from physical silver markets during that same period. Reports indicated that silver lease rates in London spiked, and that backwardation was observed between London spot silver prices and COMEX futures contracts. Backwardation in this context means that the market was pricing immediate delivery of silver at a premium over future delivery, a condition associated with tightness in the physical supply of the metal. As the week progressed into Thursday and Friday, February 19th and 20th, attention shifted to 2 developments that would prove significant for precious metals markets. The first involved Hong Kong, which reopened after its own Lunar New Year closure, having been closed from February 17th through the 19th. Upon returning to trading on Friday, February 20th, Hong Kong market saw a surge in physical gold demand despite prices already being at elevated levels. The Hong Kong Gold Exchange held a traditional Year of the Horse opening ceremony, and buying activity was notably strong. Market observers noted that Hong Kong's willingness to purchase gold at these price levels, given its close cultural and economic ties to mainland China, was interpreted as a potentially constructive signal ahead of the full Chinese market reopening. The second major development during that period involved escalating tensions between the United States and Iran. On Thursday, February 19th, President Trump set a deadline of 10 to 15 days for Iran to reach a nuclear agreement, stating that failure to do so would result in his words, bad things happening. These remarks were made at the inaugural meeting of his Board of Peace. Reports indicated that the United States had already been deploying a significant military presence to the Middle East, including 2 carrier strike groups. The USS Abraham Lincoln, already positioned in the Arabian Sea, and the USS Gerald R. Ford, reported to be heading to join it. The deployment also included dozens of fighter jets and aerial refueling tankers. A senior United States official stated that the full forces considered necessary for potential military action were expected to be in place by mid-March. Iran responded to these developments on multiple fronts. The country conducted joint naval exercises with Russia in the Gulf of Oman. Iran's ambassador to the United Nations sent a formal letter to the Secretary General, stating that in the event of military aggression, Iran would respond decisively, and that all United States military bases and assets in the region would be considered legitimate targets. The Strait of Hormuz, which is responsible for handling approximately 20% of global oil supply, was identified as a potential flashpoint in the event of any military escalation. Gold rallied strongly on both Thursday and Friday in response to these developments, closing the week at approximately $5,170 per ounce. Silver moved higher alongside gold during that same period, closing near $82 to $85 per ounce. Taking the full picture of the 6-day period into account, China's markets are returning to a gold price approximately $67 below where they last traded, a decline of roughly 1.3%. Silver, however, is returning several dollars higher than the $78 to $79 range where Chinese markets last operated, representing a gain of approximately 5 to 8% depending on the reference point used. More broadly, Chinese market participants are returning without first-hand exposure to the sequence of events that shaped current price levels, including the sharp midweek sell-off, the Federal Reserve's divided policy signals, the spike in silver lease rates and backwardation conditions in London, and the escalation of geopolitical risks surrounding Iran. Market participants are watching 3 broad scenarios for how Chinese traders may respond upon reopening. In the first scenario, China returns as an aggressive buyer, a probability assigned at 40%. This is considered more likely if gold is trading below $5,120 and silver below $85 when Shanghai sessions open, and if Iran tensions remain elevated. In the second scenario, China returns as a seller or takes profits, a probability assigned at 30%. This outcome is considered more likely if gold opens above $5,150, or if signs of diplomatic progress on Iran emerge over the weekend. In the third scenario, Chinese market activity is mixed or neutral, also assigned a probability of 30%, reflecting the possibility that different categories of Chinese market participants, institutional, retail, state-affiliated, and private, may take opposing positions that largely offset one another. Specific indicators have been identified for monitoring China's opening activity in real time. The Shanghai Gold Exchange physical premium over London spot is one key measure, with a premium above $20 considered a bullish signal and a premium below $10, or a discount considered bearish. Movement in Shanghai Futures Exchange, March silver contract. Open interest is a second indicator, with increasing open interest considered bullish and decreasing open interest considered bearish. The direction of the Shanghai Composite Equity Index upon its opening is a third factor, with a decline of 1% or more considered consistent with risk-off conditions favorable to gold, and a gain of 1% or more considered consistent with risk-on conditions that could weigh on the metal. With China's return to trading now imminent, market participants have outlined a specific timeline of events expected to unfold across the coming week, beginning Monday morning and extending through Thursday's first notice day for COMEX March contracts. Understanding that sequence is central to interpreting how the week is likely to develop across precious metals markets. The first critical window opens Monday, February 23rd, between 7 and 8 o'clock in the morning Eastern Time. That corresponds to Monday evening in Shanghai, when the Shanghai Gold Exchange and Shanghai Futures Exchange night sessions open for Tuesday's trading day. Those opening moments represent the first opportunity for genuine Chinese price discovery on gold and silver following the 6-day holiday closure. Market participants are advised to monitor the Shanghai Gold Exchange physical premium over London spot prices, the direction of Shanghai Futures Exchange March silver open interest, and the general directional flow of futures contracts during that session. Resources identified for tracking the Shanghai Premium in real time include Kitco, COM, and Gold Price. Org. The second key window arrives Monday evening at approximately 8:30 Eastern Time, which corresponds to 9:30 Tuesday morning in Shanghai, when the Shanghai Stock Exchange opens for equity trading. The performance of the Shanghai Composite Index at that opening is expected to provide confirmation of the risk sentiment already being expressed in the futures and physical gold markets. A decline of 1% or more in the Shanghai Composite would be consistent with risk-off conditions, while a gain of 1% or more would suggest risk-on sentiment that could introduce headwinds for precious metals. London markets are scheduled to open at approximately 3 o'clock in the morning Eastern Time on Tuesday, layering European trading activity on top of the Asian session data already accumulated overnight. By the time New York markets open at 9:30 Tuesday morning, a full overnight session of combined Asian and European trading will have already established a directional signal. Based on where gold is trading at that point, the data will indicate whether Chinese participants returned as net buyers, net sellers, or took a broadly neutral position. A gold price at or above $5,200 at the New York Open would be consistent with aggressive Chinese buying. A price in the range of $5,000 to $5,060 would suggest net selling. A price between $5,100 and $5,180 would be consistent with a neutral or mixed session. The remainder of the week builds toward Thursday, the final positioning day before COMEX first notice. Wednesday is identified as the session during which changes in COMEX open interest will begin to reflect whether holders of March contracts are rolling their positions forward to May or maintaining them for potential physical delivery. A significant decline in open interest on Wednesday would suggest that contract holders are rolling forward, while sustained elevated open interest would indicate that participants are holding their positions with the intention of taking or making delivery. Thursday is described as historically the highest volume session of the delivery cycle. It is the final opportunity for short position holders who do not wish to make delivery to cover their positions, and for long position holders who do not wish to take delivery to roll their contracts forward. The combination of those competing pressures is expected to produce significant price movement in both gold and silver on that day, with estimates of $50 to $100 swings in gold and $5 to $10 swings in silver cited as representative of typical activity during that session. Following Thursday's close, COMEX is scheduled to publish standing delivery numbers after the market closes on Friday, February 27th, the first notice day for March contracts. That data will indicate the total number of ounces for which physical delivery has been requested. Figures cited in connection with this cycle range from 50 million ounces at the lower end, which would be considered an orderly outcome, to 80 million or 100 million ounces or more at the higher end, which would indicate significant strain on registered inventory levels and could have implications for the April contract cycle. In summary, the reopening of China's gold and silver markets this week arrives against a backdrop of substantial developments that occurred entirely during the holiday closure period. Those developments include a sharp midweek price decline followed by a recovery, a historically significant silver streaming transaction, signals of tightness in London's physical silver market, a publicly divided Federal Reserve, escalating military tension between the United States and Iran, and a strong showing from Hong Kong gold markets upon their own reopening. China's market participants are returning to all of those conditions simultaneously, without having been present for any of them as they unfolded. The data generated in the opening hours of Shanghai trading on Monday evening Eastern Time will be the first concrete indication of how the world's largest consumer of both gold and silver intends to respond to that new market reality. That response, in turn, is expected to establish the directional framework within which precious metals markets operate for the remainder of what is shaping up to be a closely watched week across global financial markets. That concludes our coverage of China's return to precious metals trading and the key developments shaping market conditions this week. We will continue to monitor developments as they unfold. Thank you for watching.